If you owe the ATO any money right now, even a small amount, something changed that makes that debt more expensive to carry, and almost nobody's talking about it. And if you own a holiday home, there's a second change that could quietly wipe out deductions you've been claiming for years without you doing anything different. Two changes, both silent, both cost you money if you don't know about them. I'm breaking down exactly what happened, why it's shocking, and what you need to do right now if either one applies to you. Quick reminder before we start, I'm not your accountant, I'm not a registered tax agent. What I do is read through ATO rulings, budget papers and legislation and translate it into plain English so you're not caught off guard. And this one genuinely surprised me when I read it, because it's the kind of change that doesn't show up in headlines but shows up in your bank account. Let's start with the big one. Here's the shocking part first, then I'll explain exactly what it means. If you have a tax debt with the ATO, meaning you owe them money, whether that's from a return, a BAS, or basically any tax obligation, the ATO charges interest on that debt every single day it's unpaid. It's called the General Interest Charge, or GIC for short. It's not new, this charge has existed for years. What's new, and this is the part that's actually shocking, is that you can no longer claim that interest charge as a tax deduction. Up until recently, if you had ATO debt sitting there accumulating interest, you could at least offset some of the pain by deducting that interest charge on your tax return, the same way you'd deduct interest on a business loan. That offset is gone. And here's the number that makes this genuinely brutal. Right now, that interest charge sits at 11.17%, and it compounds daily, not monthly, daily. If you're comparing that to a typical home loan sitting somewhere around 6%, or even a high interest credit card around 20%, you can see how fast this adds up, especially now that there's no tax deduction cushioning the blow. Let me give you a real example so this actually lands. Say you owe the ATO $10,000 and you don't touch it for a year. At 11.17% compounding daily, that debt grows to roughly $11,180 by the end of the year, over $1,100 in interest alone. Before this change, you could claim a chunk of that back through your deduction. Now that $1,100 plus is just gone. Straight cost, no offset. Here's why this genuinely matters for more people than you'd think. A lot of Australians treat ATO debt like it's low priority. You figure it's the government, they're not going ananka after me like a bank would, I'll deal with it eventually. That mindset just got a lot more expensive. The ATO themselves have said publicly that this change is designed to send exactly that message, that carrying tax debt should now cost you more and be treated with the same urgency as any other serious debt, not parked at the bottom of your priority list. So if you've got any ATO debt sitting there right now, even something you've been meaning to sort out eventually, this is your sign to actually deal with it, whether that's paying it off, setting up a payment plan, or at minimum having a conversation with your accountant about your options. Doing nothing just became measurably more expensive than it was a year ago. Now here's the second shocking one, and this one's specifically for anyone who owns a holiday home, especially if you occasionally use it yourself and rent it out the rest of the time. The ATO has issued a new ruling that changes how holiday homes get treated for tax purposes. Here's the core of it. If your holiday home is considered a leisure facility, meaning it's not held or used mainly to earn rental income, you may no longer be able to claim deductions for things like maintenance, repairs, rates, and other ownership costs. This matters because a huge number of holiday homeowners operate exactly the model this ruling targets. You use the place yourself for a few weeks a year, maybe over Christmas or school holidays, and rent it out to guests the rest of the time to help cover the costs. Under the old approach, a lot of owners in that situation could still claim a solid chunk of deductions. Under this new ruling, the ATO is drawing a much harder line. If the personal use side of the equation outweighs the income-producing side, deductions can be denied entirely, not just reduced. Here's what makes this shocking, rather than just an annoying technicality. This isn't a future change you can plan around. The ATO has said this ruling applies to income years both before and after the date it was issued, which means it can potentially reach back into deductions you've already claimed. If your holiday home arrangement looks like the pattern the ATO is now targeting, you could be looking at a review of prior returns, not just a change going forward. If you own a holiday home and rent it out casually, here's what I'd actually do. Go back and honestly look at the split between personal use and rental use over the past year or two. If personal use is anywhere close to matching or exceeding the time it's rented out and actually earning income, that's a red flag under this new ruling. This is a genuine talk to your accountant this month, not next tax time situation, because the earlier you understand where you stand, the more options you have. I put these two changes in the same video because they share the same theme. The ATO isn't announcing these with fanfare. There's no press conference, no viral headline, no breaking news banner. They're published as technical rulings and rate updates, sitting quietly on the ATO website, and the only people who find out early are the ones actively looking. That's exactly the gap this channel exists to fill. Legislation like the tax bracket cuts or the budget headlines gets covered everywhere. Technical changes like a compounding interest rate losing its deductibility, or a ruling reinterpreting how holiday home deductions work, those slip past almost everyone until tax time, when it's already too late to plan around them. So, quick action list if either of these applies to you. If you have any ATO debt outstanding, check the current balance, understand it's now accruing interest with zero deduction to soften it, and either pay it down or get a payment plan sorted. The longer it sits, the more this new rule costs you every single day. If you own a holiday home you also use personally, pull together your usage numbers, personal weeks versus rented weeks, and get in front of your accountant before your next return, not after. If the ATO reviews prior years, you want to already know where you stand, not find out from a letter. And more broadly, if you've got any tax situation you've been putting off, either of these changes is a good reason to stop putting it off. The cost of delay just went up. 2 changes, both quiet, both genuinely capable of costing you real money if you don't catch them in time. That's exactly the kind of thing that gets buried in a 40-page ruling nobody reads. Except me, apparently, because that's the job here. Quick reminder, I'm not your accountant. This is general information, not personal advice. Your situation is your situation, so run anything specific past a registered tax agent, especially if either of these applies directly to you. If this helped, hit subscribe. I dig through every ATO update, ruling, and rate change before it quietly costs you money. See you in the next one.